All right, let's get right into it. Today, we're taking a deep dive into the structural challenges lurking within one of Asia's most dynamic economies, Vietnam. For any student of economics, understanding these issues is absolutely crucial to grasping its future trajectory.
So let's kick things off with this central paradox. On one hand, Vietnam's economy looks fantastic, right? We see high growth and pretty stable macroeconomic conditions. But like an iceberg, what you see on the surface is only a fraction of the story. Beneath the water, there are some pretty significant structural problems that could seriously limit its long-term potential.
So here's how we're going to break this down. First, we'll paint the big picture, then we'll get into the weeds, looking at public investment, the reliance on foreign investment, how vulnerable the economy is, and finally, the real capacity of its homegrown businesses.
Okay, first things first, let's give credit where it's due. You really can't talk about Vietnam's economy without starting with its incredible success story. We're talking about impressive, often world-leading growth rates, all built on a foundation of what has been, for the most part, solid macroeconomic stability.
So, if the top-line numbers look so good, where do the problems start to crop up? Well, let's look at one of the main engines that's supposed to be driving all this growth: public investment. Turns out this engine is not exactly firing on all cylinders.
And that brings us to a really critical question. The government is spending a ton of money to fuel the economy. But is that investment actually effective? Are we getting the bang for our buck that we should be? Now, this chart tells a fascinating and frankly, pretty worrying story. You see how for the first 3 quarters of the year, government spending just trickles out. Then, all of a sudden, in the 4th quarter, there's this mad dash to spend all the remaining money. It's a classic use it or lose it mentality. And you can imagine the bottlenecks and inefficiencies that creates. And this last-minute spending spree creates a nasty chain reaction. First, the positive spillover effects into the private sector are seriously limited. Second, the capital itself is used inefficiently. Think rushed, poorly planned projects. And ultimately, it weakens the state's role in guiding long-term strategic development.
Now, with that public investment engine kind of sputtering, the economy has leaned really heavily on another source of growth: foreign direct investment, FDI. But this dependence has created its own set of very distinct problems.
Just look at this. The FDI sector isn't just a piece of Vietnam's export pie, it practically is the entire pie. Foreign invested companies absolutely dominate the country's exports and its entire manufacturing base. The domestic sector is just a tiny sliver in comparison.
What this does is it creates something economists call a two-speed economy. You've got this foreign-owned sector zooming along in the fast lane, totally integrated into the global system. And then you have the domestic sector stuck in the slow lane, struggling to keep pace. This growing gap isn't just an economic problem. It can create real social tensions and make sustainable development way harder to achieve. And here's the rub. Even though Vietnam is deeply plugged into global supply chains, it's often stuck at the bottom rung, doing low value-add processing and assembly. The really valuable stuff, the technology and the innovation, isn't really spilling over to local firms. So you could say Vietnam is in the global value chain, but it's having a really tough time moving up the chain.
Now, being this open and this reliant on global trade and investment leads directly to our next big structural issue. The economy is incredibly vulnerable to external shocks.
Being so deeply integrated means that when the world sneezes, Vietnam can catch a serious cold. Things that are completely outside of its control, like swings in global trade, a change in monetary policy in the US or Europe, or geopolitical flare-ups, can have a massive impact.
And let me tell you, these external shocks don't stay external for very long. The contagion can spread with terrifying speed, hitting everything from the currency's exchange rate and capital flows to exports and industrial production almost overnight.
This vulnerability to the outside world is made so much worse because the domestic economy, the part that should be a stable anchor, has its own profound weaknesses. And you could argue that this is the absolute core of the problem we're talking about today.
It is a classic uneven playing field. On one side, you have these foreign firms with easy access to capital, technology, and global networks. And on the other, you have domestic firms who are battling high cost of capital and are often viewed by banks as just being too risky to lend to. And the money troubles are really just the beginning. They're layered on top of even deeper issues, like low-tech capabilities, very little innovation, fragmented and underfunded R&D, and a huge disconnect between what universities are teaching and what industries actually need.
So what does this all boil down to? It means that Vietnam's economic growth is still happening the old-fashioned way. It's driven by just adding more inputs, more money, more workers, instead of by becoming smarter, more productive, and more innovative. And that is a growth model with a very clear expiration date. Okay, there's one last piece to this structural puzzle, an almost total reliance on bank loans for financing. When basically the entire economy is getting its money from the same source, you create a massive concentration of risk. If the banking sector has a bad year, everybody feels the pain. It also suffocates innovation, because other funding channels, like venture capital or a robust stock market, just aren't there yet.
So the path forward has to be about diversification. To build real long-term resilience, Vietnam needs a much richer financial ecosystem. That means developing its stock and bond markets, exploring things like green finance, and fostering a whole range of non-bank financial players.
Which leaves us right here with the big pivotal question. When you add all this up, from the inefficient public spending, to the two-speed economy, to the weak domestic private sector, what does the path to a genuine structural transformation, to real, sustainable, long-term growth, what does that path actually look like for Vietnam?